Welcome back. We continue to ask that question, is the worst behind us in terms of the financial market impact of what has been, a mini storm in the first half of April? Adrian Mowat, investor at Hong Kong SAR, is with us for some perspective. Adrian, always a pleasure to speak with you. And you've seen these periods several times on one pretext or the other. Now it's this whole US tariff conundrum. So we don't know how these deals are going to happen, whether China is going to blink or not. But what's your sense? I mean, is the worst of the price damage in financial markets, is that over?
Sure it is. I think we're moving into a period where we're going to see the highest level of US tariffs, arguably in history, and certainly in terms of the modern trading history. So we're looking for an average level of US tariffs just above 20%. Now, remember that Trump did remove those very extreme reciprocal tariffs in most countries, with the exception of China, but he left in place a 10% tariff. And I think the outlook for the summer is going to be very volatile economic data. We'll have strong data as inventories were built, as companies tried to get ahead of the tariffs. And then you're going to get very weak data. People are going to be very reluctant to ship to the United States for fear that there is a deal done and tariff rates are reduced and they end up with expensive inventory. I think for the outlook for earnings looks very troubled in the United States, and I'd expect initially companies just to say they're not giving any guidance, they're removing guidance, but eventually that will move into earnings revisions going down. They're going to go down both because demand will weaken as the consumer purchasing power in the United States weakens and as margins are under pressure because of these tariffs. I think that all leads to what's going to be quite a difficult summer for US equities. And unfortunately, if US equities are having a hard time, it tends to be difficult for other equities to do well.
Hi, Adrian. Good morning and good to see you. When the US equities, but to be fair, they ran ahead, like no other global market. And they were the big outperformers. There was a rush of capital towards the US. Now, with this kind of uncertainty, what we've seen in the last couple of months or so is that India has come back because we underperformed. Valuation became a little better. And, that entire reversal of that trade, that buy China and sell India, that seems to be reversing in the last month or so. From emerging markets, do you think India is better placed at current reckoning?
So there's a couple of parts to that story. I think actually India and China are quite well placed in this dynamic that's going on here. Both countries have, an ability in China to stimulate. Indian economic growth has been relatively robust. India's exposure to traded goods to the United States is quite limited. It's obviously much greater if we look at the sale of software services, etc., to the United States. So I would agree that India has some defensive qualities. The issue that investors are having is that Indian valuations remain very high, and we're in a process of derating the US equity market. And I think that PE compression that's occurring, which is a very sensible PE compression because we're concerned that the economic outlook is very difficult to predict, so you have less confidence to pay up for high valuations. And secondly, we don't believe that discount rates are going to come down to try and compensate for that level of uncertainty. So I think at a fundamental economic level, India looks good, but it still seems to be incredibly well priced. And if you look at the dispersion in the Indian market, the likes of like a Bajaj Finance that's done incredibly well year to date, you're paying very, very high multiples for that growth and for that type of business. And I think investors are continuing to sort of be cautious about paying high prices in what's a very uncertain environment. And why China has been looking more attractive to them is that the Chinese tech names are relatively inexpensive and have actually been benefiting from positive earnings revisions. So if you think about, how does China respond to weakness in its external sector due to US tariffs? It has to stimulate domestic demand more. And so if the equity market is led by domestic demand stocks, which is what is listed in China, then they can actually do quite well. I think a lot of the damage from these trade wars is not going to be felt by listed China names. It's going to be felt by the large US multinationals, with Apple being, the poster child to how damaging these tariff wars can be.
Adrian, we'll leave it there for now. Thank you very much for joining us. Good conversation and really sharp points you make. And this is a story which we will continue to track with you over the next many weeks, depending, of course, on the pace of how this proceeds. Thank you very much for joining us.